All right, hi everybody, and today's analysis is on McDonald's stock. Ticker symbol is MCD. This is a stock that's currently trading at $220 per share, and I'm sure you've heard of McDonald's before. I'm sure you've probably eaten there. If you haven't, you've probably been living under a rock, let's be honest. Or maybe you're in a different country watching this where they don't have McDonald's. But basically, McDonald's is a big burger franchise company. Now, the thing about McDonald's is actually how they make their money is really interesting. So they're actually not a burger flipping business. They don't make their money really from burger sales. Now, they do make money from the franchisees. So they make a royalty on the amount of sales that the franchisees make. But in addition to that, McDonald's is also in the business of real estate. And so what they actually do is they will buy properties. And for example, in the 2008 financial crisis, they were going on a buying spree. They were buying properties, and these franchisees who then want to open a McDonald's franchise, they already have these properties and they already have them built and everything, and then they charge these franchisees rent. So that's another way that they make money. So the two main methods of McDonald's making money are primarily franchise royalties, but also collecting rent from their franchisees. So McDonald's doesn't really make all that much money from burgers themselves besides the royalties they get off the top line of those franchise locations. And McDonald's actually only owns about 15% of all of the locations internationally. And so most of them are owned by franchisees who then have to pay McDonald's rent. So it's a pretty interesting business model, and it's pretty lucrative too. So a lot of people don't know that about McDonald's, that they're actually in the real estate business. So I thought I'd mention that. But I will leave this article in the description if you want to read it. But moving on, we can see the share price performance of McDonald's. And as I mentioned, the share price is currently at $220 per share. And I remember seeing McDonald's in 2015. Actually, I was telling my parents to buy McDonald's because it was at $100 per share. And I thought it was a good investment back then. But really, when it comes to McDonald's, it's a long-term buy and hold company. It's a long-term dividend aristocrat stock. And actually, the dividend aristocrats, and these are companies that have increased their dividends for at least 25 years or more. I've made a couple separate videos on those, and you can watch one of those videos on the 5 best dividend aristocrat stocks up in that corner right now if you click that link. I also will leave that link in the description if you want to watch that video. But basically, McDonald's has increased their dividend every single year since they first started paying one in 1976. So we're talking 44 years of consecutive dividend increases. And so that's one of the main reasons why I would be investing in McDonald's. And yes, you are going to get some solid share price appreciation, most likely, over the long run. But in addition to that, you're getting those dividends that are just going to keep on compounding if you reinvest those dividends, because the dividends keep going up. And McDonald's currently pays $5 per share, or a 2.25% dividend yield. So you're getting a solid yield. And, the yield, as I mentioned in other videos, is not the most important thing. I mean, it's cool if you can get a 3 or 4 or 5% dividend yield, but that's not the most important thing. The most important thing is, are the dividends going up, and are you getting more money in your pocket just by buying and holding McDonald's stock? And we can look at the dividend history, and we can see that, for example, right now McDonald's pays $1.25 every single quarter, or $5 per share. So McDonald's raises their dividend every year, right? Now, they have not raised that dividend yet this year, but I'm sure they probably will in the fourth quarter, because that's typically when McDonald's raises their dividend. And if you look back at the history of McDonald's, you'll see that that is the case. That's typically when they raise their dividend. And we can go back to 2010, for example, and we can see that over the last 10 years, so for example, McDonald's was paying a 55-cent dividend, and then they raised it to 61 cents in 2010. So solid dividend growth, going from 55 to 61 cents. Then 10 years later, you're at $1.25 per quarter. So pretty substantial growth. And then if we go back to the year 2000, you can see really big growth. If you factor that in over 20 years, you're getting 21 or 0.215. They actually used to pay annual dividends, so it's important to keep that in mind. So that's why you only see one dividend here. But they are only paying 21 cents on an annualized basis, right? So think about that. You're getting $5 per share now. You were getting 21 cents just 20 years ago. That is astronomical dividend growth. Astronomical. Just divide 21 cents, 21 and a half cents divided by $5 per share. in dividends now. And if you bought 100 shares of McDonald's and you were getting paid basically $21 a year for owning McDonald's in the year 2000, and now you're getting paid $500 a year, and that dividend most likely will be increased again before the end of this year. So probably a little more than $500 a year over the, and that's for doing nothing but purchasing 100 shares of McDonald's back in the year 2000. And so not only has your investment appreciated in value, gone up quite significantly, but in addition, you're also getting much more in dividends. So it's one of those things where you are getting huge returns in the dividend and also some solid share price appreciation. Definitely, probably the main reason I'd be buying McDonald's is for the dividend, and the reinvestment of those dividends can add up to a significant sum over the long run. But if you're a retirement investor, for example, if you're in retirement and you're looking for some solid dividend stocks to own in retirement, McDonald's is definitely a stock you should consider, in my opinion. Now, let's move on to the dividend payout ratio. And the dividend payout ratio, in case you are unaware, is basically the earnings per share divided by the dividends per share. So how much in dividends are they paying out versus their earnings per share? And so they have a current dividend payout ratio of 77%, which is pretty stable, and that's fairly consistent when you look at other companies like the Dividend aristocrat stocks. You'll see a decent dividend payout ratio, maybe in the 50, 60, 70% range, sometimes higher, maybe 80%. But as long as you're not seeing like really close to 100% or over 100%, that's when you should really be concerned. Because if that's the case, then what happens is, there's two reasons that can happen, or a combination of these reasons. It could be either one or the other, or it could be both of them. But let's say their earnings have fallen sharply, and so they're trying to maintain the dividend with lower earnings, and so that dividend payout ratio jumps up above 100%. So that could be a sign that they're not going to be able to maintain the dividend in the future. Or let's say they've increased the dividend so dramatically and their earnings per share has not kept up with the dividend that is being paid out. So that's something else that can happen, or it could be a combination of both of them. And that has happened to stocks in the past. And if the dividend payout ratio gets way out of whack, that could be a sign that the dividend is going to be cut. It's just something to keep in mind. So, as long as it's in like the 60, 70% range, even 80% is okay. Just not as long as it's way over 100%, or even if it's over 100%, I'd be looking into the company a little bit closer just to see what's going on. But anyway, let's go over to the financials and find out more about McDonald's and what kind of numbers they're posting here. So if we look back at 2019 on an annualized basis, we can see that their revenues came in at $21 billion. And in 2015, their revenues were actually a bit higher, going back, just looking at these numbers. And then we had $24 billion, $22 billion in 2017. So their revenues have gone down. However, the good news is their gross profit has gone up. And as you can see, from 2015, their gross profit was $9.7 billion, and now their gross profit is $11.1 billion. So that's good. So even though their revenues are lower over the last 5 years, their gross profit has improved. Now we can also look at the operating income, another metric that a lot of investors like to look at. $7.3 billion in 2015 and $8.8 billion, or almost $8.9 billion, as of the end of 2019. So that's good. The operating income is going up. And then we can go down to net income. And the net income in 2015 was $4.5 billion, and in 2019, or at the end of 2019, came in at $6 billion. So even though their revenue has gone down, the other numbers are improving, which is good. Now we can go over to the balance sheet, and this is important. The balance sheet is very important in determining the health of a company. How much debt do they have? How much cash do they have? There's a lot of things to look at on the balance sheet. What I like to look at is how much cash they have. Is that cash fairly consistent? And also how much debt they have. I mean, is their debt exploding? Total liabilities versus total assets and things of that nature. But we can look at the cash balance, for example, and we can see that their cash balance kind of does fluctuate a decent amount. We can see in 2015 they actually had a lot of cash on the balance sheet, $7.6 billion. At the end of 2019, they just had under $1 billion in cash. So keeping in mind that a lot of this cash is being paid out in dividends, but like for example in 2016, $1.2 billion you can see there in 2016 at the end of 2016. So the cash balance kind of does fluctuate a lot. I would like to see what the cash balance is at the end of 2020, how much they have on their balance sheet. I'd like to see more cash on the balance sheet, honestly. I think that's kind of a low number for how large of a company McDonald's is, honestly. Now, if we go down to their long-term liabilities, we can see that their long-term debt, for example, this is debt that's typically due over the next several years, and we can see that the long-term debt has been increasing. So the long-term debt in 2015 was $24 billion, and at the end of 2019 came in at $34 billion. So there's pretty significant increase in the debt there over the last 5 years. And so you're basically seeing $10 billion in new debt, keeping in mind that McDonald's is a very large company, but also you have to factor in the reality is the more debt they have, the more money they're going to have to pay out in that debt. So the more their interest expense and things of that nature are going to go up. And looking at their total assets versus total liabilities, they do have $55 billion in total liabilities on the balance sheet and $47 billion in total assets. So is their balance sheet the strongest? Probably not. I think their balance sheet needs to have more cash on it. I think that they need to try to maintain or not go into so much debt. I understand they're trying to, grow the business and things of that nature. So sometimes you do have to take on debt to do that. But one thing I will say about McDonald's, even though they are a dividend aristocrat stock and the dividend growth has been phenomenal, I think they are taking on a lot of debt, and that is one consideration if you're an investor. I'm not saying McDonald's is a bad company to invest in. I actually do like McDonald's. I think they are a good business, but I would be watching the balance sheet and keeping an eye on how much debt they have and things of that nature if you're an investor, just because it does kind of concern me a little bit with how much debt they're adding and also how little cash they have relative to that debt. I mean, will they have enough cash if they see a significant downturn in their business? And also realizing that demand for McDonald's remains relatively constant. Even in a recession, people still go out to McDonald's. And so will that have an impact on their franchise location sales? Probably. In a recession, you probably will see a downturn. And we've seen this in the past. It does happen. And with the coronavirus, I'm sure people are going out less. But nonetheless, McDonald's has been open throughout this pandemic, and their sales are probably still going to remain relatively steady. I'm not going to say that there's not going to be a dip at the end of this year or that we wouldn't see anything like that after this fourth quarter and all the financials come out for 2020. But McDonald's is more of a recession-proof type of restaurant just because people like to go out and get cheaper meals during a recession. They don't want to go to the fancy sit-down restaurants. And during this pandemic, people have actually been going to McDonald's a lot more just because all the sit-down restaurants have been closed. So it's a lot easier to go through the McDonald's drive-thru when you can't actually go inside and eat at a restaurant, even if you want to. So that's something to keep in mind. But overall, I think McDonald's is a good company. I do like their dividend growth. It's been phenomenal. They have a reasonable dividend payout ratio, and their net income and operating income and things of that nature have remained relatively stable. But like I said, the one thing I don't like is the balance sheet. I think they have added way too much debt in the last few years, and they need to get that cash balance up and really save for a rainy day in case something goes wrong with their business, because that cash balance has been drained. Even though it fluctuates, it is looking kind of low right now. So that is one consideration. But anyway, let me know if you are an investor in McDonald's and what you're doing for your portfolio. I'd love to hear your thoughts. If you're new to the channel, be sure to hit that subscribe button so you don't miss out on any of these stock analysis videos. I also do other types of content as well, like how to make money and also other types of investing content. And I will be doing more of those videos in the future. But I did want to do kind of a series on dividend aristocrat stocks and things of that nature so that you can get a better idea of, maybe some safe dividend paying companies that you can own in your portfolio for years to come and really not have to worry about the share price going up or down. But as long as you're getting that dividend growth, that's really good. And that's something that a lot of investors love about dividend investing, is that you just get compounding dividends that keep on going up over time. But anyway, guys, once again, let me know what you're doing for your portfolio in the comments down below. And until next time, I'm Drew Stegman, and I'll see you in the next video.